Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I am Merryn Somerset Webb. We are recording this episode on September 24th. Now, this week, I am speaking with Roger Lee. Roger is currently head of equity strategy at UK-based investment bank Cavendish. He's been in the equity market for a long time, nearly 30 years, spending time at HSBC, Deutsche Bank and JP Morgan. Most recently, he was head of UK equity strategy at Investec. He's got a lot of experience here. He's covered UK equities, European equities, US equities, and of course, crucially, he's also a fellow of the Institute of Chartered Accountants, a physics graduate, and a frustrated politician. How's that for an intro? Roger, thank you so much for joining us today. I think we might all be frustrated politicians.
Thanks. Thanks very much for that wonderful introduction. In fact, frustrated politician, in fact, the least successful politician ever, because I tried to get selected twice and failed both times dismally. Frustrated, but not so frustrated now, I have to say.
Yeah, no one wants to be a politician right now. And that is exactly what we're going to talk about. And one of the reasons that I asked you on, Roger, is I've read some of the things that you've written about the fiscal situation of the UK and just how bad it is, and whether there is a possibility that it is so bad that it genuinely does cause a fiscal crisis and possibly the downfall of this government in the UK, which seems an extraordinary thing to say, given that this is a government with a huge majority. You look at them and you think, well, surely they'll go a full term. But actually, of course, as my colleague John Stepek always says, we must try to think of this less as a majority government than a coalition government because of all the different viewpoints inside the tent. And with that in mind and the fiscal position in mind, things may be a little bit more tenuous than perhaps our Prime Minister would like to think. So why don't we start by looking at the fiscal position in the UK and just run us through quite how bad this is?
But let's just step back for a second and just think what a fiscal event is. Now, most of us have lived through a fiscal event, which was clearly Liz Truss back in 2022. And a fiscal event is usually considered something when the gilt market gets very concerned and gilt yields rise very rapidly. In that particular instance, gilt yields went up 100 basis points, or 1%, in a four-day period. And there had to be some sort of intervention from the Bank of England. And clearly, European sovereign debt crisis was a series of fiscal events. They are uncommon, but they do happen. And it's usually characterised by government debt yields going up very rapidly. So that is a fiscal event. Now, again, for background, there have been, since this government came into power, there have been 3 mini fiscal events where gilt yields have gone up 20 basis points, 0.2%. So not anywhere near the 100 basis points that you would cause some problems, but they have moved very quickly, in some cases in a matter of hours. And the 3 occasions were immediately after the October budget last year, when the market got very concerned about growth outlook and increased issuance. In January, when gilt yields went up, partly because US Treasury yields were going up, but also concerns about growth. And then, of course, during Rachel Reeves, our Chancellor's difficult day in the Commons, when gilt yields went up 20 basis points in a matter of minutes. We have had 3 occasions when there has been some sort of stress in the gilt market in this administration. And what I think we're going to talk about now is what would prompt that to be significantly worse than just a 0.2%, 20 basis point move.
Okay. And?
So what I think prompted this, and what I think has prompted a lot of people's interest in what might happen, is really following on from the public sector net borrowing numbers. Now, to older listeners, that used to be called the public sector borrowing requirement. So if I do mix the 2 up, they are essentially the same. So the public sector net borrowing requirement is really the funding requirement the government has, or at least in this particular instance, it's obviously a deficit, is that the government is spending more than they are receiving in tax revenues. And the OBR and the ONS publish this data every month. Now, in August, which was the data that was published last Friday, it was clear that the government is spending a lot more than they're generating in tax revenue. In fact, I'm not going to burden you with too many numbers, but I'll just give you some sort of context here. In August, the government had to borrow, or the deficit between spending and tax revenue was £18 billion. Now, that compared to an OBR forecast for the month of just under £13 billion, so a 40% overshoot. Now, that in itself is not necessarily a problem. What is a problem is that for the first 5 months of the year, spending has overshot tax revenue by £16 billion. That's for 5 months. Now, this isn't particularly complicated, so just bear with me. But if the government has overspent by 16 billion in 5 months, that's just over 3 billion a month. If that run rate continues for the year, then that's clearly 36 or 38 billion rounding up. So let's call that 40 billion of overspend for the year. Now, that again isn't necessarily a problem, except compared to what the OBR are forecasting for the debt for this year. So the OBR are forecasting that debt levels actually start to come down, or the rate of the deficit slows towards the end of the year. There's always this kind of seasonal effect in this as well, because we pay our taxes in January, so borrowing does come down seasonally. But they're expecting debt to come down significantly from last year. Again, I'm sorry to give you some numbers, but our context is important. So last year, the government borrowed about 150 billion. That was the deficit last year, 150 billion pounds. And this year, the OBR are forecasting the deficit to be around 120 billion pounds. So clearly less than last year.
Okay, hang on, take me back a bit. How does that connect to the 40 billion we were just talking about? I thought you said it was going to be around 40 billion by the end of the year.
So we're currently overspending by 40 billion.
Yeah.
If we annualise the current overspend.
Yeah.
But the OBR is expecting debt to be lower this year than last year.
So they're expecting it to turn into an underspend over the next 7 months.
Yes.
Yeah, effectively.
Or they're expecting the revenues to pick up and spending to slow. Absolutely. So the question I think people are beginning to ask themselves is, what if spending doesn't slow? What if tax revenues don't increase? What happens if we carry on spending at the same rate as we did last year? Now, if that is the case, then last year we overspent by £150 billion. So if we have the same outturn as last year, that is still more than the OBR are forecasting. But as we stand today, we're spending, or the deficit is higher than it was last year. So there are two issues here. One, why will the deficit come down in the second half of this year? And secondly, if it doesn't come down and the deficit run rate continues as it is in the first 5 months of the year, then the conclusion is that the deficit will be 150 billion if it was the same as last year, but including the overspend, or the increased deficit, increased run rate, however you want to describe it, that is an additional £40 billion.
Okay, now we get to the number.
So the outturn could, and I stress could, be closer to 190 billion of deficit, not 120 that the OBR are forecasting. So that is the kind of the punchline here. And it is not just me doing the numbers. And as I say, this is just purely arithmetic. It's not a forecast. It's not our house view. It's not a central case. It is just merely extrapolating the arithmetic that we've seen over the last 5 months and making a not unreasonable assumption that the deficit this year is going to be closer to the deficit that we saw last year, and then adding that overshoot onto it.
Okay, let's carry on with this terrifying conversation by talking about what it is that the OBR expects to bring tax revenues up and spending down over this year. and the extent to which that may or may not happen? Are they expecting an increase in tax revenues, for example? And if so, where?
So there are essentially three areas where the OBR are forecasting that forecasting both tax will be higher and spending will be lower. And we can discuss the likelihood of whether this will actually come to pass. But the three areas that they're talking about is that capital tax receipts will be higher in this fiscal year than last year. Now, most economists think that might be the case. There is a possibility that could be the case.
And that would be the case, sorry, just to interrupt, that would be the case, why? Because the rate has gone up and because with markets doing very well, et cetera, and more people will be making capital gains because people are beginning to sell, for example, buy-to-let properties they've held for quite a long time, and there'll be a rate of capital gains coming from those. So all these things combined. I
think that's the general argument, yes.
Okay.
Yeah.
Thank you.
The second area where the OBR think that the deficit will start to fall is because lower debt interest. Now, that is the debt interest that the government have to pay to issue new gilts into the market. Now, that the OBR, again, broadly speaking, forecast 10-year Treasury yield, 10-year gilt yields to be 4.5%. Gilt yields are already higher than that today.
What are they today?
4.7.
Yeah.
And obviously 30-year gilt yields are even higher at close to 5.5%. So it is very difficult to see how lower funding costs are going to help this deficit issue. In fact, if anything, it will be the reverse. And the third area that the OBR are still believing will reduce the deficit, and this is on the spending line again, is that they're expecting lower growth in welfare spending. Again, it's difficult to see how that is going to be the case, given that the welfare cuts that had been proposed clearly were rejected by the Labour Party back in July. So it's difficult to see why this deficit's going to come down in the second half. Now, what is perhaps easier to see is if the economy continues to slow, as it's doing at the moment, and if the labour market continues to deteriorate, and we saw some disappointing survey data earlier on in the week, if the employment market continues to slow, then growth will slow, and therefore tax revenue will slow. So the income side of this might slow because of slowing growth, and the expenditure side might rise because of increased welfare payments in order to support those who are no longer in work. Now, we've already seen an element of this in last Friday, which again I think is why last Friday's PSNB numbers were so interesting, is we've already seen an element of this because one of the reasons that the OBR said for this overshoot in the deficit or overshoot in the borrowing requirement was because of lower VAT receipts. Now, lower VAT receipts are directly linked to demand, they're directly linked to growth, and they're directly linked to consumer confidence. And so what we're already seeing is that lower demand feeding through into lower purchases, lower basket sizes, and that is feeding directly through into lower VAT receipts. Now, VAT is one of the largest tax generators in the UK. Now, again, this is not a huge surprise. Lord Wolfson, in his next report, which I think you referred to recently in one of your podcasts. We did.
John and I talked about it in one of our market roundups because those reports are always incredibly insightful. So it was not something I wanted to read. He's so good.
Hugely insightful. And I think you cited the fall in vacancy rates and the issues that, or the lack of vacancies that Next now have and the number of applicants that they have going up. What he also obviously cited right at the front of the report in his outlook statement was that he's concerned about slower consumer spending. Now, that is already directly seen by the OBR in those lower VAT receipts. So, again, it's not a question of being sort of sensationalist in any way. It is just, what the OBR said on Friday, was that net debt had exceeded expectations by some 40%. And the reason for that, there was also elements of local authority funding, which is quite technical and has a habit of reversing anyway. But what was very tangible was lower VAT receipts. Now, I'm not sure anyone out there is forecasting a huge surge in growth for the remainder of this year. In fact, I would suggest that most people are forecasting the reverse. Most economists are forecasting the reverse. So
for that maths to reverse, sorry, carry on.
I was always just going to conclude that if anything, given the risks to the economy, the risk, therefore, would suggest that actually tax revenue will be less than the ABR are forecasting, and also, or even less than last year, and the risk that welfare spending will be higher.
So for this to turn around, for the math to pan out differently, we either need a sudden, very unexpected surge in growth, a sudden, also very unexpected, massive decline in our spending, particularly on welfare, which is the obvious area, or a sudden collapse in interest rates, in gilt rates. And none of those things seem very likely right now.
Yeah, well, that's an interesting one. Absolutely. To an extent, government finances are very straightforward. They're very similar to our own personal finances. They have income from tax revenue. They have expenditure, which is what their spending programs are. And if there is a gap between the two of them, a shortfall, then they have to borrow. That is no different to any of us in terms of how we fund our day-to-day expenditure. Now, instead of going to a bank, clearly, they go to the Bank of England or the Debt Management Office and they issue gilt. Now, one of the reasons why this is perhaps more relevant now, and certainly why we have started talking about it a bit more, I stress again that this isn't necessarily a forecast. One of the reasons we have talked about it a bit more is because our view is that interest rates were going to fall quite sharply towards the end of the year. So our view was slowing economy as a result of the corporate change in behaviour as a result of the last budget, and the national living wage would result in a slowing economy, which is what we're seeing. Yep. There would be a response in the labour market, which is what we are seeing, and therefore the Bank of England would cut rates. Now, the Bank of England are clearly not going to cut rates because inflation is still very elevated in the UK at 3.8%. And arguably a lot of that is to do with the pass-through of the national living wage and the national insurance contributions, particularly in the food sector, and energy prices related to net zero, which again, I think you discussed at some detail in a recent podcast.
We have.
So I won't go down, I'm not going to add anything to that. Suffice it to say that it looks in the market certainly not expecting any interest rate cuts anytime soon. In fact, maybe only one more this year. Now, that's very different to the forecast that we would have had 2 or 3 months ago.
Yeah,
that makes a big difference. And that is what has changed. What has changed is that we would have thought that the Bank of England were going to be able to cut rates quite aggressively. There is a fairly strong correlation between falling interest rates and improving growth. That would have stimulated the economy, and that perhaps would have been the surprise that you were just talking about. That perhaps would have been the surprise that you would have seen in terms of both the growth and therefore the tax take and obviously reduced welfare spending. And more importantly, perhaps reduced, and clearly that would have had an impact on gilt yields now in terms of where the curve would have gone. And that would have reduced the funding cost. So if you wanted to really pin down what has changed, 2 things have changed. One is that there's interest rate cuts aren't likely, and we would certainly agree with that as well in the short term. And secondly, what's changed is the current spending dynamic is a lot worse, and the tax take dynamic is a lot worse than we were expecting. And it's those 2/3 factors that have changed.
Yeah, and the market has definitely noticed this. I've talked about this a lot on the podcast, but the fact that debt costs in the UK are, at the moment, they are still higher than any other G7 economy. So even though our debt situation on the face of it is not necessarily worse than some other developed economies, we're paying more for our debt than other countries.
That's irrefutable on a 30-year basis. And there are some structural issues around the 30-year bond yield. I mean, 30-year gilt yields now, just to give some context for this, compared to the G7, the 30-year bond yield is just around 5.5%. The US 30-year, which is the next highest, is 4.7%.
Yeah, it's a big difference.
It's a very significant difference. Now, I stress some structural reasons why that may be the case, but nonetheless, it is quite clear that the global capital markets, which is where we get most of our funding from, because up until now, relatively few people in the UK own gilts. We tend to save through bank deposits rather than buying gilts. That is a compare and contrast with other countries. So we are very reliant on the international markets in order to fund this deficit, in order to fund our borrowing. And so therefore we are also very prone to how international bond yields move. But as things stand at the moment, the markets are clearly demanding a premium for a number of reasons, possibly this risk that we're talking about is partly that.
Okay, so the question then, that brings us to the crunch of the whole thing, is how long before things get worse? And as we know, we've been talking on this podcast and various other places where John and I have written and spoken for years about the massive buildup of debt across the developed world and how uncomfortable it is, not just here, but elsewhere. And we know, you learn from how long you talk about it, that these imbalances can build up and not be a problem and not be a problem and not be a problem. Everything's fine. And it goes on for much longer than you could possibly imagine. And then suddenly it turns, and when it turns, it also turns much, much faster than you could conceivably imagined before it actually happened. That's how we become complacent, and then kaboom, everything goes horribly wrong. And in a situation like this, you get to the point where the market says, well, hang on, it's costing you so much just to service this debt, you're in a big pile of trouble. And so what happens next? How do we get to this point?
Okay. Well, there's a great quote, and I hope you haven't used this too recently, but there's a great quote that in economics things happen slower than you would have thought and then faster than you thought they could,
exactly.
Which I think is just so true. But what happens next? Now, again, just for the benefit of your listeners, this is now... Not a forecast. We're now just describing a possible scenario of what happens next. Maybe you'll indulge me in this flight of fantasy, and I'll leave you to judge how real or not this may be. Now, again, I have to give some credit here to Andrew's sentence and some of his great ex-posts on this. And he seems to think that this event could happen in Q3 or Q4 this year, and I'm going to just briefly talk about why that could be the case. So it comes back to this public sector net borrowing number that comes out every month. Now, if the debt profile of the UK or the deficit profile of the UK continues on its current trajectory, as we talked about in some detail a few minutes ago, and it doesn't come down as we were suggesting, then each month we will get an overshoot to what the OBR are forecasting. At some point, the market may extrapolate that through using the arithmetic that we have very simplistically done just a few minutes ago, and they may come to the same conclusion that if the run rate continues and the debt profile this year, or deficit profile this year, is the same as in 2024-5, and therefore we have 190 billion, or as Andrew's sentence described, 185, so pretty close to our arithmetic. Now that is a very big number. Again, I'm going to throw your listeners another number here. The total size of the UK economy is around £2.7 trillion. So 200 billion of deficit is around 7% of GDP.
Wow.
I mean, that is a huge number. Wow. Huge. So, of course, just to reference that, the ECB, as part of the Euro criteria, insist on around a 3% deficit, and that would normally be what a normal economy should run at. These are just huge numbers. Now, if the gilt market remotely felt that the UK deficit was anywhere close to that number, and therefore had to be funded by increased issuance, given that the last three occasions when there was a threat of increased issuance, the gilt market moved by 20 basis points, 0.2%, suddenly confronted with one of the worst deficits in the Western world and a funding requirement of something like 80 billion or 70 billion more than the OBR are forecasting, more issuance, therefore price must adjust to that increased supply. And gilt yields, the price of gilts will fall and the yields will rise. And this is how you get into this potential gilt yield spiral. So gilt yields start to rise in order to compensate the gilt holders for obviously more issuance. It's a simple supply-demand dynamic. And at this point, then, gilt yields start to rise. Now, the problem you get, and there were some very specific instances around trust, but what you then get is the cost of funding goes up as gilt yields go up. We talked about that briefly. It's one of the big swing factors in the government's P&L and finances. And so gilt yields start to rise. That increases the funding costs. That therefore increases the deficit, which means more issuance. So therefore gilt yields go up again. So this is when you get into the crisis of more issuance, higher yields, more issuance, repeat. It's a vicious spiral. And we've seen evidence of this around the world many times. And that then is the problem that the government will have to deal with. What you would expect to happen, and this is getting to the rub of this discussion, you would then expect the Bank of England to intercede. Now, the primary duty of the Bank of England is financial stability. Gilt yields moving very rapidly. Again, we can remember what happened in trusts. Mortgages get withdrawn.
Yes.
Financial markets start to suffer significant stress.
What sort of number would you put on gilt yields for it to hit the kind of level of crisis that the Bank of England would intervene?
Oh,
5.5, but on the 10-year, is that?
It's about 100 basis points would probably be sufficient to cause this. And that's not based on sort of any scientific measure. It is merely observational of what happened during the truss, what happened gilt yields, bond yields in the periphery during the period of the European sovereign debt crisis went up a lot more than that. I mean, Treasury yields getting to 4.9% in January. As I said this morning, they're around 4.7. They got to about 4.9% in January, and that was beginning to raise alarm bells. If they went to 5.7, then I think you have a problem.
Okay.
And I think most people would think you would have a problem at that point. That would be 30-year gilt yields at 6.5%. These are big numbers. And so at this point, in this scenario, the Bank of England would be required, or it's part of its mandate, to ensure financial stability in the UK, and therefore would have to intercede. And the intervention would be, again, similar to what we saw with Truss, and that is that they would start some sort of QE programme. They would start backstopping the gilt market. They would start buying gilts. So they would completely reverse their QT and have to start buying again. And they have the capacity to buy and do whatever it takes, to use those words, in order to stabilise the gilt market. The question comes, what price they would expect the government to pay for that. And I don't mean a financial price necessarily, but what financial discipline will they impose on the government? And again, this is purely hypothetical fantasy. But it is difficult to imagine that the Bank of England would be happy to backstop a situation like this unless there was a significant display of fiscal restraint by the government. And I don't think that is unreasonable. The risks of not forcing fiscal restraint on the government would jeopardise the reputation of the Bank of England as a fiscal custodian of our finances. And that could actually
such as it is.
And your words, not mine. And I think given their sort of recent track record, I think the last thing that the Bank of England would want to be accused of is fiscal irresponsibility. What normally happens here, and again what we've seen in the periphery, is that the Bank of England will insist on fiscal restraint and fiscal responsibility So just going back to those numbers I just talked about, a 200 billion deficit, huge, is a 7% fiscal deficit for the UK. You could easily see the Bank of England insisting that be halved. And they would insist on that as part of this backstopping of the UK gilt market.
You get to the point where the bank
is now getting very painful for any sitting government. Again, just to give you the numbers. So that would be around deficit at that point, let's say, keep the numbers very simple, be around 200 billion. And the Bank of England would probably, potentially, insist on that deficit being halved to 100 billion through some sort of emergency budget. And this then becomes a political decision.
Okay, so then we go from maths to politics. So you get to the point where the government has to take an emergency budget to Parliament and ask its MPs, that very large majority, to sign off on 100 billion quid's worth of cuts, a large amount of which would presumably, because it's got to be quick, probably fall on welfare, I'm guessing here, plus probably a sharp and immediate rise in income tax to cover quite a lot of it. And you're going to ask people who've promised in their manifesto not to raise income tax and to, as a party, prefer to increase rather than decrease welfare spending. And then suddenly you get a budget that doesn't pass and you have a proper old crisis.
Yes, that is very succinctly put. I think that is the issue. And again, we can put some numbers about that and some sort of recent precedents to it. Saving £100 billion very quickly. That's the sort of austerity level that Osborne and Cameron did at a post-financial crisis in terms of over a several-year period. To get that into some sort of 100 billion into some sort of context as well. A penny on income tax raises about £10 billion. So, as you said, tax rises, you could easily see basic rate of income tax going up several pence to cover this. And then you've got to address the welfare side of the equation. So let's say half of this was paid for by tax rises and the other half paid by spending cuts. That's £50 billion worth of spending cuts. On one level, we spend about 1.3 trillion in the UK. So that is clearly less than a 5% cut. But politically, as you will recall from July, the government were unable to get £5 billion worth of spending cuts through. And we're now talking a figure, hypothetically, of 10 times that amount. This would be very challenging, I would have thought, for the Parliamentary Labour Party to vote through. Very challenging. And it's this scenario that then leads to an interesting constitutional question. Now, clearly, I'm not remotely pretending to be a constitutional expert, but if a government is unable to pass this emergency budget because their sitting MPs refuse to do it, and this actually may be an unintended problem of having such a large majority. If they are unable to pass this budget, then convention suggests that at that point the government have to dissolve Parliament and go to the country and have a general election. It's only happened once in the UK, in 1909 as it happens, but so we do have to go back quite a long time. I wasn't even in the market then. And it's only happened once, but it's happened on a number of occasions in parliamentary systems that have a similar structure to Westminster. So being unable to pass a budget is clearly fundamental to how you govern a country. And so if they are unable to pass a budget, then one would expect at that point a general election to be called. And that enters into a whole realm of other topics.
Yeah, that would take us straight on to what happens after that, which might be outside the scope of our imagination. If Nigel Farage is talking about or thinking about expecting an election in maybe 2027, maybe he might get his wish, and that would all be rather interesting. I mean, the key point being that you've run us through maths as opposed to politics. You've run us through what could happen given the numbers as opposed to what anybody might want to happen. But nonetheless, it does feel that we are getting to this point where very slowly and then very quickly, and at some point, either something massive has to change or we do need a crisis that forces that change. So there's a sort of growing sense of inevitability of running at the edge of the cliff, isn't there?
Yes, I don't I don't think no one's pretending that the fiscal situation in the UK is anything other than challenging. That is not remotely a contentious point to make, I don't think. And also, I am not sure, and again, I'm not sure this is a particularly contentious point either, that this situation of ever-increasing taxes at the same time as ever-increasing welfare spending without any growth is probably unsustainable.
Well, it does get very difficult when you have no growth, because when there is no growth in an economy, you are constantly shifting the pieces of pie around between people, right? And that is obviously going to cause conflict. Whereas when you have growth, there's more pie to share, so you don't get quite the same level of anger as you do when there is no growth. The lack of growth is in itself a thing that creates conflict, right?
Oh, yes, it is the lack of growth is the problem. The government are absolutely right to focus on growth, as was Liz Truss. It's a question of how you achieve growth, but growth answers all of these problems. The problem is, at the moment, we don't have any.
Okay, now let's move on from this potentially, you call it it's not a zero risk event. I'd say it's slightly quite a lot more than zero at this point. But let's say that this is out there as a possibility. If this happens, if we end up in this kind of scenario, and again, so many moving parts, none of this can be sure. These are, as you said, not forecasts, simply suggestions of possibilities. But if we do get to this situation when we have both a fiscal crisis and a constitutional crisis concurrently, what happens to markets? All that nice growth we've seen in the UK equity market, it just leaves us in a wanna. What happens?
That's probably the easiest question to answer that you will post to me all day. They will go down. They will go down a lot.
Yeah.
So that's actually a bit of a facile answer, because some bits of the market will go up a lot and some bits of the market will go down an awful lot, and that's what we see. So let me just answer give your listeners a couple of ideas here what happens. If we know what happened in the 2 hours after Rachel Reeves's difficult day in Parliament, we obviously know what happened in the market then. And what happened was that the metals and mining sector, which obviously is international earners, and it has gold within that, and it has copper, that sector went up. I can give you the exact numbers. That sector went up 4% over that 2 hour period. The UK real estate sector and the UK house building sector went down 6%. So in 2 hours, there was a 10% spread. These are big numbers. And we also saw, you can go back to Truss and see what happened there, is that generally speaking, the FTSE 250, which is very much more domestically exposed, went down a lot. And the FTSE 100, which is obviously more internationally exposed, went down, but not as much. Because clearly it has dominated by companies that have international earnings. Now, that's not a complete defence in this environment, because obviously it's the UK that the market is very concerned about at this point, and so even those international earners tend to fall, but just not as much as the domestic plays. So we see the market moves, these market moves are very pronounced, they are quite dramatic, and they are also quite extreme. But before that sounds all too frightening, there's also another aspect of this that is often ignored, is that market crises do pass.
Yes.
And they do pass. The tools are there. They may be painful for the current administration to administer, but someone will have to administer them. And that then creates a very interesting opportunity going forward, just as during Truss created a very interesting opportunity for those who are able or nimble enough to and have the courage to buy through the crisis. The opportunities that result from this can be quite profound.
So it's worth holding it. It's worth holding a little cash, a little more cash than you might have otherwise, next to your gold, obviously, and the emeralds you're going to put in the hem of your skirts.
Yes, not to give financial advice, but I think having a bit of cash at the moment is certainly could be, if one is concerned about the outcome of this outcome, then having a bit of cash is probably no bad thing, because it will throw up some very interesting investment opportunities.
Yeah. Roger, we'll have to give the studio back soon, but I just want to ask you a couple more things. And the first is Is this contagious? Obviously, as we said at the beginning, while we're paying more to borrow than all other G7 nations, nonetheless, on paper, our debt to GDP ratios are not particularly worse than other countries. So easy to possibility that if we reach some kind of fiscal crisis point in the UK, that then causes sovereign bond investors around the world to go, well, hang on, if the UK can't get this under control, then maybe France can't either, and the US can't either, et cetera, and it becomes a rolling fiscal crisis.
Yes, I think that's a very good question. Obviously, global financial markets are very interlinked. There is a competition for capital between all asset classes, as it happens. I think the contagion, to the extent there would be contagion, is perhaps the other way around. I think another risk that we haven't really talked about, and is maybe one for another day, as I did touch on that in the little mini gilt scare we had in January, that was partly because US Treasury yields went up. And we obviously have to compete with capital against them. So the contagion could be the other way around. A trigger to this could actually be US Treasury yields going up. It could be concerns about the US deficit. It could be concerns about presidential interference in the Fed, and the independence of the Fed could cause international investors to demand a higher return from the US. Now, as it happens, the US Treasury yields are reasonably stable at the moment. So some of those concerns perhaps have passed. So there's certainly a contagion the other way around, that if something happens bad in the US debt market, then it would almost certainly have an impact on us. Likewise, another potential scenario which could cause contagion, JGBs, so Japanese government bonds. If the inflation outlook in Japan continues to be persistent, then JGBs will go up, yields will go up. And again, this idea that everything's interlinked, and all of sovereign debt, all of G7 sovereign debt goes up. So there are other factors here. Now, specifically on France and the UK, because obviously we are the two countries that are right, or France, for instance, is right in the eye of the storm. Anyone who thinks that what I've just described is unreasonable or inconceivable, we only have to look 19 miles away across in France and see that the political disarray that they're enduring. Now, France is in a slightly different situation to us, obviously, because it's part of the euro and it has the ECB sitting behind it. I think to an extent there is less of an element of contagion because the ECB has more levers to pull because it's managing a zone of multiple different economies. So to an extent, I think, and this isn't particularly scientific, but to an extent, the French government debt is slightly more protected because of the ECB as opposed to us on our own with just the Bank of England behind us. I think we have seen some very clear correlation between French oats and gilt. So yes, that correlation probably works. Okay. I think the interplay between France and the UK could be quite interesting in this scenario. Or concerning, should I say.
Okay, I love the way you use quite interesting as a euphemism for all sorts of things. We might make a list of that. Things Roger thinks are quite interesting.
Yeah, things that strategists think are quite interesting, generally speaking, are bad.
Yeah, and the rest of us would call absolutely terrifying.
And the more interesting and exciting markets get is usually
the worse it is for your living standards. Listen, let me just ask you one last question before you finish. Are you reading anything interesting at the moment? Are you reading a good book, fiction or non-fiction, that maybe our listeners should be picking up?
Oh, yeah, I'm a bit of a nerd on this sort of things. I'm reading
That's what we like.
I'm reading Dominic Sandbrook's History of the 1970s.
Oh, I've read that. So good.
Two volumes of it.
Yeah.
Actually. I'm almost through one volume of it. So
yeah, no,
I think that's very interesting. And again, you can probably tell where I'm heading on this. But over the summer, I read Philip Ziegler's biography of Ted Heath. So you can obviously see.
Okay, I can see exactly where
my
you're
thought
going.
process is going here at the moment. So
yeah,
there we go.
Maybe go back and listen to some of those podcasts on gold, everybody. Roger, thank you so much for joining us today. We hugely appreciate it.
Thank you.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review and subscribe wherever you listen to your podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on X. I'm at MerrynSW and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Sadi and Moses Andam. Sound designed by Vic Maples, and special thanks, of course, to Roger Lee.